Welcome to Looking at the Markets with David Modell. The 200-day moving average. Is it meaningful? Is it important? Is it tradable? And is it trouble when the market breaks and closes below the 200-day moving average? And everything I'm saying in this video, I'll be using the SPY, which represents the S&P 500. I'll be using that as the example, but I believe that what I'm going to say today can be applied to individual stocks or other indexes or commodities, currencies, whatever. I believe it applies pretty universally, at least in my opinion. All right, so let's take a look at, and we're going to start with the simple moving average, the 200-day simple moving average, but we'll also look at the exponential moving average as well. All right, so this is 2018, and we can see that, yes, it went below. This is the daily candlestick chart of SPY, which represents the S&P 500. Yes, it went below. It didn't close below, though, so that might not count. Back in early April, it broke below the 200-day moving average, but came right back up. But it didn't close below it, so that might not count. Here it touched it, but didn't really close below it, so that probably won't count for most people. This should count, though. Recently, it closed below the 200-day moving average, but then went right back up. We don't know yet exactly how this is going to play out, but so far it's gone and stayed above, right back above the 200-day moving average. But that's just one example, and again, we don't know how this is going to play out, which direction it's going to go. So we're going to have to go back further to really see, but first, once again, I said that was the 200-day simple moving average. Let's change it to exponential. Again, we're using stockcharts.com. Want to give them credit. Is the exponential moving average really that much different? Well, interestingly, wait a minute, we got to put it to, got to change it to 200. There we go. All right, so if we put on the exponential, is it really that different? I would say no. All right, in my experience, long term, the EMA and the SMA for the 200 are really not that different. And we could see here that it's not. Back in, looks like February, it touched it. April, it just kind of touched it, but that might not count for a lot of people. It just touched it here in May, closed below it in October, but then came right back above. So pretty much the same story, whether you use the simple or exponential 200-day moving average. In 2017, it did not close below the 200-day moving average at all, not even once, believe it or not. So we can't look at that. We have to go back further. If we want more examples, we have to go all the way back to mid-2016, believe it or not. All right, so let's take a look at what happened there. Back in, looks like late June, we're looking at the simple 200-day simple moving average, and it broke below and came right back up, way up, and then went sideways and went up more. All right, so it doesn't look like it was any trouble here. All right, let's go back even further for more examples. Oh wait, sorry, we got to look at the we looked at the simple, want to look at the exponential for the exponential people. Make sure we put it on 200. There we go. Let's see how that looks. Pretty much the same story. Whoops. Stockcharts.com is flipping out on me. Come back. There we go. Okay. Yeah, it broke below, closed below about the same time, came right back up. Looks like it broke below a little bit here on the exponential moving average for the 200-day. And barely broke below, but it looks like it did, but then shot right back up. So false signals. All right, let's go back even further. All right, this is 2014 and 15 and the first half of 2016. We have a lot more examples here. All right, so in 2014, looks like we had a correction here. It broke, closed below the 200-day moving average, came right back up. Didn't stay very long. Okay. And then all right, so now we do have the two 10% corrections, both of them double bottoms, as they say. And that's in late 2015 and early 2016. Okay. So, yeah, it broke below, and then it kept going And it stayed there. Okay, so it stayed there for a few months, but then came right back up. So this was not a market crash. So the people who said, okay, it broke below the 200, it's trouble. Well, it didn't turn out to be a market crash. It turned out to be just a run-of-the-mill 10% correction, which is normal. These things happen. All right. And then here, broke below, came right back up. No market crash here. Broke below, came right back up. Broke below, came right back up. 3 in a row here. A lot of people don't remember those, maybe, but there they are. 3 false signals in a row. Broke below it. Another 10% correction. Okay. Another double bottom, came right back up, and we know what happened after that. Okay. So kept going up. All right. So that's quite a few examples here. So for the people who say, let's also look at the exponential, but I suspect it's going to be the same story. There we go. 200-day update. What do you want to bet? Same story. Yep. Broke below, came right back up. And pretty much the same story here. A lot of false signals. All right. So does the S&P 500 closing below the 200-day moving average, is that trouble? Is that a market crash? Well, we've got plenty of examples of it not being a market crash. Okay, back in 2008 it was, but there are a lot more examples of it not being the beginning of a real crash. All right, so it could be the beginning of a correction, but if you went short every single time it broke below, you probably wouldn't have done too well overall, because we have enough false signals here. And or even if, okay, so if you shorted here, you would have done okay temporarily, but that's hindsight, all right? You would have had to know exactly when to get out all these times. It's easy to say, oh, I would have known back then, but come on, that's hindsight, which is always 20/20. Now, what about the strategy of, some people say, well, okay, it's not necessarily trouble if it closes below the 200-day moving average, but maybe I can buy when it breaks back above and then sell when it breaks back below, and then buy when it breaks above, and then sell when it breaks below, and then buy above, sell below. Well, okay, you would have run up some commission costs with all the chop around here. All right, but let's see how that would have worked out. Well, let's use this one as an example. You would have, let's say, bought here and enjoyed a nice run up, and then sold here. Well, that's a pretty good run up here, right? And then you would have bought here, sold here, bought here, sold here, bought here, sold here. Just kind of went sideways. You would have lost probably some money on commissions, unless you used a commission-free broker. And then you would have sold here and then bought back lower here. Okay, that's not good. All right. And so we could look at the examples. You would, and in this one, you would have, you would have sold here, bought here. I'm starting to, sold here, bought here. I'm starting to think that maybe you would have done better, comparatively speaking, just buying and holding. Well, actually, I found an article, and I'll put the link in the description below this video. Somebody actually back tested it this year. All right, this was a few months ago, but so they, these people, they didn't count the most recent one, but still, they have the past 30 years of data here, and they back tested it. So if you just bought and hold the S&P 500 over the past 30 years, you would have made about 8% per year. That sounds about right. I always say it's between 8 and 10% per year, typically, if you reinvest all the dividends, that kind of thing. But let's say 8%. Okay. Now, what if you used that strategy of if you bought when the S&P 500, broke above the 200-day moving average, and then you switched to cash, or you sold whenever it broke below the 200-day moving average, and then bought back when it went above, and so on, you would have earned an average of around 6.5% over the past 30 years. So just doing nothing, just buying and holding, would have gotten you 8%. And SPY, by the way, has a dividend. So I don't know if that includes reinvesting the dividends. I imagine if you did, you would have made even more than 8%, possibly. All right, so I'll put a link to this article in the description below the video. It's from bullmarkets.co. Pretty cool. All right, so is it tradable? And the title of this article says it all. The 200-day moving average isn't as useful as you think. So is it tradable? Compared to buy and hold, not really. I don't think so. And this article writer, Troy, doesn't seem to think so either. Is it real trouble? Well, it depends what you mean by trouble. It could be a correction, but 10% corrections are normal. And a lot of the times it was just noise. It just went right back up. All right, here and here, and here so far. I don't know how this is going to play out. We'll find out. And intraday, it broke below a few times, and it touched here, and that meant nothing. So I don't find the 200-day moving average particularly useful. I hate to say it. I don't know. Maybe you have a strategy that is useful. Put it in the comments below. If you like using the 200-day moving average in a different way, let me know. And maybe you could use it with another moving average, like with a lot of people like to use the death cross, which is when the 50-day moving average crosses below the 200-day moving average, and then the golden cross when it crosses back above. So maybe if you combine it with other things, other indicators, it can be useful. But just by itself and using the candles breaking above or below, I don't know. I don't know how meaningful it is. I don't particularly use it by itself as very meaningful. All right, so I hope you enjoyed this video. Hey, subscribe to my channel if you like this video, and hit that notification bell so you can get updates on whenever I put out new videos. And give this video a thumbs up, please. And if you liked it, and leave comments. And I also offer help to people who want help with indicators, moving averages, and putting together a trading or investing plan, because you got to have a plan. Otherwise, you're probably not going to do too well. All right. And so my email address is davidmodell@gmail.com. Thank you so much. I appreciate it, and I'll talk to you again soon.